For decades, whenever something went wrong in the economy, there was one institution everyone looked to for rescue: the central bank. Cut rates, inject liquidity, calm markets, restore confidence. And for a long time it worked, or at least it appeared to. But today that playbook is breaking down. Central banks are no longer fixing problems. They are managing symptoms, and even that is becoming harder by the day. The reason is simple: the problems facing today's economy are no longer cyclical. They are structural. Central banks were designed to smooth business cycles, not to solve deep-rooted issues like unaffordable housing, excessive debt, demographic decline, inequality, or collapsing productivity. Yet over time, they were forced into roles they were never meant to play. After the 2008 financial crisis, central banks stepped in aggressively. Interest rates were slashed to near zero. Massive money printing followed. Markets stabilized. But a dangerous precedent was set. Every crisis would now be met with cheaper money and more liquidity. That strategy inflated asset prices instead of fixing the real economy. Housing soared. Stocks soared. Debt exploded. Productivity did not. Fast forward to today, and central banks are trapped. Inflation forced them to raise rates, but higher rates are breaking the very system that was built on cheap money. Governments are drowning in debt. Households are stretched. Companies are over-leveraged. Markets are addicted to liquidity. Every rate hike causes stress. Every pause fuels bubbles. Every rescue creates the next crisis. This is the central bank dilemma. They can fight inflation but risk recession, defaults, and market crashes. Or they can support markets but worsen inflation, inequality, and currency debasement. There is no pain-free option left. Look at housing. Central banks can raise rates to cool prices, but that also crushes affordability, freezes supply, and locks people out even longer. They can cut rates to help borrowers, but that just reignites speculation. Monetary policy can't build homes. It can only distort prices. Look at wages. Central banks can't force productivity growth. They can't retrain workers. They can't create stable jobs. All they can do is influence borrowing costs. And cheap borrowing increasingly benefits asset owners, not workers. Look at debt. Governments rely on low rates to survive. Central banks know this. That's why tightening never lasts. The moment financial stress appears, liquidity returns. Markets have learned this, and they price assets accordingly. That's why bubbles keep forming. Central banks are no longer leading the economy. They are reacting to it. And every reaction makes the system more fragile. The most dangerous part is credibility. Central banks depend on trust. Trust that they can control inflation, stabilize markets, and act independently. But when the public sees inflation stay high, living costs explode, and inequality widen, that trust erodes. People feel it in their daily lives. Groceries cost more, rent keeps rising, savings earn nothing. Debt costs everything. When official messaging says the economy is strong, but lived experience says otherwise, belief collapses. Once belief collapses, policy loses power. This is why central banks can't fix this economy anymore. Not because they are incompetent, but because the problems are beyond their tools. The real solutions lie elsewhere: housing supply, fiscal discipline, productivity investment, fair taxation, and structural reform. Those require political courage, not monetary tricks. Until that happens, central banks will keep doing what they've been doing: buying time, calming markets, and postponing pain. But postponement is not prevention. The era when central banks could paper over every crack is ending. And when people finally realize that monetary policy can't save them from structural decline, the conversation will have to change. The question is not whether central banks will act again. They will. The question is whether anyone still believes it will actually fix anything.